Thank you very much. Welcome, everybody. Glad you can join us. We're expecting a nice crowd. Looks like we already have one. Today's topic, an exciting one. We just received, of course, legislation on Friday on the advanced child tax credit. But let me first start by introducing our illustrious panel here. First, we have Jacob Goldin, who is an associate professor of law at Stanford University Law School and has been very active in this space and providing comments and writing papers on the topic over the last several months. Second, we have Elaine Maag, who is principal research associate at Urban-Brookings Tax Policy Center and has done a lot of research in this space as well and has been instrumental in helping me and others understand what's going on, and as well as helping us with various comments. And then finally, Nina Olson, who needs no introduction, the former taxpayer advocate and the current executive director of the Center for Taxpayer Rights. So we have what is kind of what I'll call, aside from me, the dream team on child tax credit issues. And so what I think we'll do today is we'd like to explore really three major areas with respect to the advanced child tax credit. First is eligibility issues, and Jacob will be talking to us about that. Then we're going to turn to reconciliation-related issues during filing season, and Elaine will lead that discussion. And then finally, last but not least, of course, are the ever-important adjudication issues with respect to this newfangled system when multiple people claim the same child, and Nina's going to lead that discussion. Before we get into those particular topics, I thought it might be just helpful to provide a little background as to how we got to where we are today. There's been a lot of movement in the child tax credit area over the past several years. I think hopefully all of us would agree in a good direction. It's getting larger and going to the people who absolutely need it. Prior to the current iteration of the child tax credit, we had an increasing amount allocated to the credit prior to 2021. So in 2020, taxpayers could claim up to $2,000 for each qualifying child, and up to $1,400 of that was refundable. There were various criteria to have a child qualify, or a taxpayer qualify for respect to a qualifying child. We're not going to go into all the old history there, but you have it there below you as to the requirements. We're going to see, though, an evolution of these requirements as we kind of walk down memory lane here before we get to the latest iteration of the credit. So we then, of course, we moved to the current state of play, the 2021 Advanced Child Tax Credit. It's a temporary provision. It arrived in the American Rescue Plan, or ARP, and I don't know what happened there. Apologies. So, yeah, okay, back. Sorry about that. For the first time, it decided to disconnect when, of course, we're live. Anyway, the 2021 Advanced Child Tax Credit, it expanded and increased the child tax credit to $3,000 for children ages 6. That should say 17. That's my bad. And $3,600 for under 6. There are certain income thresholds that are necessary for it to apply to, but the vast majority of taxpayers are eligible. Second, it made the child tax credit not just fully refundable, which is a change from partially refundable in the previous iteration, but also 50% advanceable. So a new concept here where you're getting at least a portion of it early in advance of filing the actual return in which the credit would be claimed, which creates its own set of issues. And then finally, it created a reconciliation concept that would be trued up at tax time, but there was a safe harbor that was provided, and the safe harbor, in essence, was there to ensure that folks who actually received that actually had already received the advance payment wouldn't have to necessarily return it except under very specific narrow circumstances. One of the issues that had come up as a result of the passage of the American Rescue Plan, and specifically this new concept of an advanced child tax credit, was what to do about taxpayers who don't normally file a tax return because they're below the income threshold and aren't required. And on May 17th this past year, or this current year, Revenue Procedure 2021-24 was issued, was published, and it really simplified things for those low-income taxpayers who would otherwise not be required to file a return. It permitted them to, in essence, file a return with, in essence, a $0 amount on it in an effort to make it easier for them to claim the advanced child tax credit. In essence, giving access to the credit to the folks who most need it, and typically are the ones who are missed out on the opportunity. It also added guidance to for e-filing for the sole purpose of allowing the taxpayer to access the advanced tax credit. One more thing I just want to mention before we move on to the latest proposals is the Taxpayer Portal requirement, which came out of the American Rescue Plan. And then here the service would be required, or is required, to provide an online portal to allow taxpayers to vote to opt out of the advanced child tax credit if they want to just get it all at the end of when they file their return. Or I should say, in addition to that, it also would enable them to provide relevant information to the government to enable them to update their status, whether it be that there are additional children, or the number of children go down, or a new child is born, or their marital status changed, or whatever else may have changed throughout the year. And the IRS, I think, put their best foot forward to put together a portal in a really short period of time that they were given. And along came Code for America, which was also working on their own portal, which turned out to be perhaps more robust and user-friendly. And so as of September 1st, it was launched, and the IRS is directing, I think, taxpayers to use the Code for America portal. The two benefits of it, two of many particular potential benefits of it, include the fact that it's available in multiple languages, not just English. And second, unlike the IRS's portal, this has a mobile edition, which is made available to many folks who don't necessarily have computer access, but do have a mobile phone. So quickly moving on to where to kind of tee things off for our panel here. First, we have Treasury came out with its Green Book, as you know, earlier this year. And one of the proposals was to expand the advanced child tax credit through 2025 and make it permanently refundable. In addition, they suggested that Treasury and the IRS would develop various strategies to mitigate potential concerns about, I hate to use the term, but I'll call it fraud and abuse, but folks that maybe try to take advantage of the system. At the same time, they realized there's a balancing act that needed to take place, because for this to be successful, it needs to be able to get out to the folks who actually need it, and too many hurdles would potentially jeopardize that opportunity. So they recognized this balancing act, and they did suggest giving IRS and Treasury broad authority to help in the enactment of the provision. Finally, or most recently, this is hot off the press from Friday, on September 10th, Ways and Means Committee released a portion of their tax bill. The rest came, I think, Monday. But on the Friday edition, we received the proposed language for the advanced child tax credit. And like the Green Book, it extended it to the monthly concept, continue the monthly concept. This time it would be all 12 months, wouldn't just be partially advanceable. The same $3,000 and $3,600 credit would be available through 2025. I believe there's a inflationary adjustment to take place as well. And then it had some unique provisions in it that we're going to spend a lot of time talking about today. One of utmost importance is the presumptive eligibility standard that was established. Jacob will talk about that. An expedited process for taxpayers who meet certain requirements to kind of get a quick answer as to if there's a question about their eligibility. And Nina's going to talk to us about that and some of the benefits and potential pitfalls of such a process. It also provides for retroactive payments under certain circumstances and a recapture provision. And Elaine's going to talk to us about those issues. And then finally, it talks about a certain, like we'll call it the stick, to ward off potential bad actors, with both a 10-year disallowance period that you can't claim the credit if you commit fraud with respect to the child tax credit, and then a 2-year disallowance period if instead of fraud, it's intentional disregard of the rules or regulations. And I think Nina will talk about that a little bit as well, and also questioning like where you draw the line and how you determine whether you've committed one or both or some of these and where the line gets drawn. So with that, let me hand over the platform to Jacob, and he can talk to us about the eligibility rules under these new proposals.
Great. Thanks, Scott, for organizing the panel, for including me. It's an honor to be on a panel with Nina and Elaine, who I've learned so much about these issues from. Scott already mentioned some of this, but for context, I'll cover the current law that governs the child tax credit and most other kid-related tax benefits right now. And then switch over to talking about the new eligibility rules in the draft bill from the Ways and Means Committee. Scott mentioned it came out Friday. He didn't mention it came out at like 10 p.m. Eastern on Friday. So, all of this discussion is a bit preliminary, I think, for all of us, and we're all sort of trying to understand it as we go. So, important caveat. Okay, so let's see. So under current law, the question is for the child tax credit, somebody has to be a qualifying child for the tax credit. The age requirement is under 17. Through this year, it's 18 for 2021 for one under 18 for this year temporarily. One of the big requirements is a residency requirement. The child has to have the same principal place of abode as the taxpayer for more than half of the year. So 183 days, 181 days, they don't qualify. So it's an all or nothing rule. The relationship test is a big one and a big point of difference relative to the new bill. So the relationship test says that for a taxpayer to claim a child, the taxpayer has to be the child's parent, grandparent, aunt or uncle, sibling, relationships like that. Some in-laws, foster parents, step siblings, sort of close enough relative. There's a self-support test, which means that only kicks in rarely. The child can't provide more than half of their own support. And then there are some tiebreaker tests, which are really two different types of tests, all sort of called tiebreakers. There are extra limits. So under the current law, if a parent could claim a kid, the only way that a non-parent would also be able to claim the kid is if the non-parent's income is above that of the parents. And then the tiebreaker rules also come in and give us rules for if two or more taxpayers try to claim the same kid for the same year, whose claim is prioritized. And basically it prioritizes claims based on the parent over non-parents, and income over higher income taxpayers over lower income taxpayers. Okay, so those are the current rules. Before we get into the weeds of the new eligibility rules, I want to step back briefly and provide a bit of context for the broader picture of the proposed reform. And we'll see that, what is sort of the best eligibility rules is important to understand in this broader context. A lot of them, what we're going to turn to, are in the weeds, but it's all happening in the backdrop of a pretty massive change in which kids would be eligible for the credit under the proposed bill, under the new draft language. So, well, let's see. There's no. Okay, the figure's not coming up. That's fine. So let me just say qualitatively what's supposed to be on here is the child tax credit has refundability based on income. So what that means is that if you don't work at all, you don't qualify for any credit. And for low income workers, they only qualify for a partial credit. What that means is that the current credit, and when I say current, I don't mean 2021, I mean before 2021 and what's scheduled to come back for years after 2021. So the way it's designed right now, it doesn't benefit the children who are growing up in the lowest income households. The only so what that means is that if and what should be on this figure is the vast majority of kids living in the lowest decile of the national income distribution, they're completely ineligible for the CTC, and the majority of kids in the bottom 30% of households by income, they're only eligible for a partial credit. And then in contrast, basically everyone, all the kids in the households in the top half of the income distribution qualify for the full credit amount. That also has sort of predictable distributional patterns by race as well. And so if you basically 3/4 of white and Asian children are eligible for the full child tax credit under current law, compared to only about half of Black and Hispanic children. So a lot of the changes that are happening under the new bill, in addition to sort of the in the weeds changes, it also would be very big changes in eligibility in terms of making these lower income kids eligible and these children of color eligible for the benefits. Okay, so that's sort of big picture. What is that happening? And now, in terms of the specific eligibility rules, I'll walk through those right now. But at a high level, these are more tweaks, I think, than most people expected the bill to make. So really, it shows sort of like listening, I think, to a lot of the criticisms that have been made, including by Nina and Elaine, of the current design, the current qualifying child rules, and trying to tweak those going forward for the child tax credit. And specifically in this context of something closer to a universal child tax allowance, child allowance, that's going to be available to the vast majority of kids. Okay, so starting with the top point, this idea of month-by-month eligibility. In contrast to under the current law, eligibility, basically claiming a kid, is determined month by month. So you have an annual credit, which is the sum of the monthly credits. And so what that means in practice is that instead of a taxpayer being able to claim a kid all or nothing for the year, if a kid moves into a taxpayer's household partway through the year, they'll be able to claim the kid for the months they were with the kid and not for the other months. That's important for kids who are moving between households and sort of housing instability. It's also important in the context of a credit that's being paid out monthly so that people don't have to repay months that they've already sort of received if a kid then moves out of their household later in the year. The second point is the age. It's sort of making permanent sort of the broader age range or maintaining the broader age range of kids who qualify. The residency rule is adapted from the current version. So instead of an annual test where the kid has to live with the taxpayer for more than half the year, under this monthly residency test, the kid has to live with the taxpayer for more than half of each month that the taxpayer is able to claim the kid. There's a new requirement which replaces the relationship test. So there's no relationship test right now. What instead comes in is this caretaking requirement. And the rule is that the taxpayer has to provide uncompensated care to the child in order to claim them. What does it mean to provide care? Well, this is a multi-factor, sort of a facts and circumstances analysis, going through sort of basically the things that you would think, like who's responsible for the kid day to day. If there's a medical issue, like who's responsible for that, who arranges their education and transportation, sort of the things you would sort of expect to go here. And this really draws on the Canadian system, which has a universal child allowance, pretty much that uses the primary caretaker and has sort of a established case law and jurisprudence on what it means to be sort of a caretaker for a kid. And so we're sort of adopting similar factors here.
Jacob?
Nationality? Yeah.
Just as an aside, on the care requirement, we talked a little bit as a panel when we were preparing, the possibility of how child support payments might be treated in this context, and whether we know they're not compensation for other areas of the code, but whether it could be treated that way and potentially knocking out whether a particular taxpayer is eligible for the credit and seemingly not applicable the state and local carve out for benefits that are received from the government. Any thoughts by the panel on this issue?
Well, it seems like obviously the correct result that child support shouldn't count. If you receive child support, that shouldn't mean that you provide compensated care to the kid. It should still mean that you're providing uncompensated care. I think everyone would agree with that. And so I think you're right. It wouldn't hurt to have more clarity in the bill, making that point.
And I just did want to add one thing, Jacob. This is for everybody, especially in the audience. We want to encourage you to ask questions. We haven't received any yet. And so instead of taking questions at the very end, we were hoping that if you have a question in real time, you could ask, and we will do our best to filter through and answer as many as possible. So sorry, Jacob, for interrupting. Go ahead.
No, please, yeah, interrupt as much as possible. I don't, I get bored hearing myself talk. But I'll be wrapping up pretty soon. I'm just gonna a couple other sort of big changes to flag. One is this sort of the based on requirements based on the child's like citizenship status or immigration status, and under the the historical rule had been that children with ITINs were eligible to be claimed for the child tax credit. The 2017 reform changed that and required the child to have a social security number authorizing the child for work, which effectively eliminated from eligibility a lot of kids who would benefit from the payments. And so the Ways and Means draft brings those kids back in. So it doesn't maintain that social security number requirement. And then finally, there's sort of similar tiebreaker tests to what exists under current law, although they're a little bit different in that now that non-relatives are able to claim kids, they're sort of put in the lowest bucket after parents and after non-parent relatives. And then sort of within groups and sort of across groups, there's also this sort of similar rule about income. So you have to be higher income. If you're a grandparent and you want to claim a kid, you have to be higher income than any of the parents who live with the kid as well. Okay, so I'm just want to
interruption. Sorry for the delay here, Jacob. We did get a question. The question asked about compensation in the context of uncompensated, meaning welfare, and if we could be a little clear, provide some clarity with respect to certain payments such as TANF and SSI payments. I think we've already sort of mentioned, hopefully, that there's a particular carve out in the legislation to specifically state that those types of payments are not compensation for this purpose.
That's right. I think uncompensated, my read is that it's, if you just read sort of caretaking on its face, you might think that like a live-in nanny or like au pair or something would qualify to claim the child, which is sort of not the goal. And I think the uncompensated is trying to prevent situations like that. Okay, so I'm going to flag sort of two specific issues, sort of which I think are maybe concerns with how it's written right now, and then a couple other issues to talk about, and then I'm sure there'll be much more sort of that comes up in the discussion. So the first is this elimination of the relationship test, and overall I think this is a very good step. This is something that people have focused on as the problem right now is that some kids are not claimed by, you don't live with a close enough relative. Maybe they live with a cousin, maybe they're being raised sort of in an informal foster situation by like a close family friend. And the problem is that those kids can't be claimed for the child tax credit under the current laws. It's hard to get a handle on exactly how many kids that is. In some other work with Kathy Mitchell-Moore, we estimate about 330,000 kids a year are still left out, even when the credit is made sort of fully refundable, as it is in 2021. So a big pro of getting rid of that relationship test is bringing those kids back in. Here's a potential problem, though, is that the relationship test might be an effective way to channel benefits to the child's main caregiver. So if you have a parent living with a kid and the parent's partner also living there, it might be correct, and probably is correct, that the parent is probably more often the one who should be getting the money and who's probably providing the main care for the child, and for whom payments would actually benefit the child more. than going to like the parent's partner. Often the situation, right, is where it's a mom, child, and then the mom's boyfriend. And then the other big part of this context, and especially in low-income communities, is the prevalence of domestic violence and financial abuse and domestic abuse situations where, you know, the money from the child tax credit could be a really important way for the parent, the victim of domestic violence, to get financial independence, be able to move out with the child, have sort of a safer situation. And so if there's coercion, you'd be worried that the boyfriend would be able to claim the kid. And so one problem with getting rid of the relationship test is potentially opening the door to that. And so one possible solution would be to limit non-relative claimants, like the boyfriend, from being able to claim the kid only in cases where there's not a parent who's present who would be able to do so. That, I think, gives sort of the best of both worlds, where if there is a parent, the benefit should probably go to that parent. And in cases where there's not a parent present, it makes sure that the kid is able to be claimed by somebody, so you don't have kids being excluded. Okay, so that's one sort of policy concern with the eligibility rules as written. A second one is, and this is more sort of in the means of just there's a couple of ambiguity aspects. So one aspect of the draft that's nice, I think another benefit, is that it codifies existing case law that says that if a kid is temporarily absent from a household, that could be anything from in the foster care system to like juvenile detention to summer camp, that does not necessarily defeat the residency test, as long as the kid is sort of expected to come back to the household. Now, one thing the bill text does say, though, is that if a kid is temporarily absent from a household, the child is treated as only living in that household. So, in some senses, I think this rule goes too far, and in other cases, it doesn't go far enough. So one place it might not go far enough is this temporary absence rule is phrased as an exception to the the residency test. But it doesn't necessarily. So if a kid, goes to live with grandma for a few months, it could be that the kid is temporarily absent from the parent's household. Fine for residency, but it could be that what about the kid? This new caretaking requirement, right? So if the parent isn't providing care in those months where the kid is gone, it could still be that the parent wouldn't be able to claim the kid unless the temporary absence rule is interpreted to also apply for the caretaking requirement. So that's one sense. The exception in the text might not go far enough. One sense in which it might go too far is this idea that if a kid is temporarily absent from a house, that house is the only place where the kid is treated as living. And so what does that mean? So if kid leaves mom's house to go live with grandma for a few months, this rule would say kid is not treated as living with grandma for those months. So that means that even if mom does not claim kid or is unable to claim kid for those months, there's no ability by grandma to claim kid for those months because kid is not treated as living with grandma for those months. So that's sort of maybe going too far. And so I think those could be clarified. And finally, I just want to flag a bunch of issues that we could talk more about. One is joint custody situations. Often kids go back and forth between households when we're trying to establish eligibility on a month-by-month basis. We don't want people to have to sort of keep track of exactly which days the kid was where. A nice system that many people sort of proposed was and which other countries allow, like Canada, is to have two parents or claimants split the kid 50-50 and just be in the system and getting 50% of the payments each month. Another thing to figure out is the interaction with non-custodial parents. Right now, non-custodial parents can claim children from the child tax credit if the custodial parent waives the right. The draft says allow something similar, but what does that mean with respect to caretaking? How does that interact again with the caretaking requirement? Is something to figure out. All these rules are for specified child as opposed to a qualifying child, which is what governs other tax provisions, other child-related tax provisions in the tax code. How do we think about the interactions of these? Of course, there's a disconnect. How should we, how much sort of unification should be required in cases where they do sort of overlap. And then the last point is, again, this sort of month-by-month residency test. How should we think about how to limit the burden to taxpayers of having to prove residency or their care for each specific month in an audit situation? Are there sort of tweaks that would let the taxpayer prove that they cared and lived with the kid for maybe just like any one day during the month, and that would at least give a presumption that it would be enough? So, happy to talk more about these in the rest of the discussion, but let me end there. Thanks.
So Jacob, thank you very much for discussing the, go ahead, Nina.
I was just going to say that, going back to your issue of temporary absence, there is a provision relating to the child tax credit today that's in this bill, relating to fraud or intentional disregard, or the reckless or intentional disregard of the rules and regulations. And it's an exception to the safe harbor protections that Scott referenced, that if you have an overpayment of the credit. And part of the language actually talks about people making arrangements between themselves, essentially, to receive the credit for a child that isn't with them. And that might be like, to most people, a normal reaction. Well, okay, you've got this temporary absence rule. I'm getting the credit, but I'm going to give the payment to the grandmother. But that could possibly be contemplated as an arrangement that would trigger, not being able to give you any safe harbor protection. So I think we really need to have clarity about that. That's just part of the concerns that I have about the punitive sections of the legislation, but it's triggered again by that temporary absence issue.
And interesting, we did receive one other question that I'll just quickly pose to the group, and I think it's maybe answered in the fact that this is a refundable credit, 100% refundable, and so therefore it takes some of the incentives out of play. But the question was asked, will parents be able to allocate this credit, and will it be tied to dependency exemption, or does the care cutoff that ability to barter and negotiate the credit? And I think, I'd like to pose it to the panel, but I would think the fact that it's 100% refundable takes away a lot of the potential or incentives to play games, because if somebody wasn't eligible, they could sell the credit to somebody who was, but here everybody's eligible in essence, regardless of income status. It's at the lower end.
Well, the proposed statute expressly says that the rules of 152E, where the custodial parent can waive the credit and give it to the non-custodial parent, actually apply. So there would be bartering in family law situations where you're dealing with custody or equitable distribution and trying to arrange child support. So that rule is carried over to this, much to my personal dismay.
Well, and one thing just to add to that, I think Nina's absolutely right in what she said, but current 152E says a non-custodial parent who's providing child support but not really otherwise interacting with the kid very much can claim. I think as written, I think it's an open question of whether this sort of a similar rule to 152E would also carry over the child care requirements.
Right.
Because if it did not, if it only sort of brought over residency, then the non-custodial parent would have to actually provide some care in order to qualify.
Right. That's really interesting. Yeah.
I know we want to get to the next topic, but I think there's one question that I think is something I know Jacob and Elaine, we've spoken a lot about, and I know Nina's written a lot about. I'll kind of give a summary of it. In essence, the question is with the presumptive eligibility standard now, that it goes on indefinitely until either the secretary provides that it should be stopped, or the parent elects otherwise, or I should say the eligible parent elects otherwise, who is presumed to be eligible. The question asks, what happens if somebody else actually becomes eligible under the general standards of the statute, and raising any equity issues that might arise because that person just happened to be, receiving the payment at the end of the day, or sorry, caring for the child but wasn't the original caregiver. What any thoughts about that?
So I'm definitely concerned about putting the burden on the new claimer instead of sort of requiring the person receiving the credit to, report that the child's no longer with them. But, I think these issues will get sorted out as, we think a little more deeply about it.
Yeah, I think that's exactly the right way to think about it. In practice, we know that especially for lower income populations where kids move around households, often there's other things going on when a kid leaves a household. Some sort of like instability going on, financial or mental health related, or substance abuse related, or otherwise. And families are just, we know in practice, are not going to be in a great position to immediately, first thing on their mind when the kid moves out to report the change to the IRS. And so there's really sort of, in situations where the change is reported after real eligibility changes, but families have already been paid for the months, there's just three options. That you could either force the family to pay it back and give the new family eligibility, the new household eligibility. You can leave the payments with the old family, and the new family gets eligibility going forward once they report. Or you can let both, you basically release the old family from paying it back, and also let the new family claim retroactively. And I think that's sort of an inescapable tension. What the bill seems to adopt is somewhere between 1 and 3, basically, where for the most part the onus is on the new family, is on the new family to report the change to the IRS to start getting payments, which sort of limits the extent to which the old family has to pay it back, with sort of a grace period and hardship exemption, I think designed to deal with these sort of most egregious equity type cases, where in those situations the new family can claim retroactively.
So my particular concern about that is, first of all, the center has done a survey of state law regarding other benefits like SNAP and TANF, and in every single state that we looked at, the statute requires change of circumstance notification by the old family. Whether they enforce it or not, and the penalties that might go with that, it's in the law. And what's striking in this version of the bill is that there's no obligation to do change of circumstances. At least in the Affordable Care Act, we required, we put in, you need to inform people of your change of circumstances. And so I would hope that that gets picked up. So there's at least some responsibility on the old family. And I would also point out that for a new family, having a child plopped in the middle of you, that is a child that is under stress, that is no light thing either. And so it might very well be that for the new family, it's an incredible burden immediately to come in. They might come in eventually after they're going through all the other things that they have to sort out with respect to that child, like food stamps, like healthcare, like getting them into an educational system, getting them to a doctor. But eventually they might come in. And so you need a system that allows them to get the payments for which they might be entitled because they are the carer of the child, but for the presumptive eligibility. And I think that's the challenge between, dealing with the recapture and dealing with the retroactive eligibility. And that's why I've been a big advocate for rebuttable presumptive eligibility as opposed to irrebuttable presumptive eligibility. And that'll really come up when you look at the adjudication provisions. What does all that mean? But I think, I'm very sympathetic to, these are times of great stress, but I think they're, for different reasons, times of great stress for both parties in this transaction. And we should be putting, some kind of obligation on the old family to come in and notify the IRS that, the child is moved.
So thank you, Nina. Great questions coming in. I think it'd be best now, in the interest of time, that we move on to our next topic. Elaine's going to talk to us about some reconciliation issues, and then we'll finish up with Nina on adjudication issues. So it's all yours, Elaine.
Thanks so much, Scott. I also extend my thanks to you, not just for putting this panel together, but for the extraordinary amount of work you've been doing to try to get these provisions right and administrable and working for families. And it's just really nice to see from my perspective. So I wanted to spend a little time talking about how we've had one system of how we calculate our taxes and we reconcile them, after the year has ended. And we're sort of shifting into a new world. And there's a lot of reasons we're doing that. But I want to just walk through what our choices are. And then at the end, sort of those choices, who you prioritize will lead you to which choice you make. So as everyone in this room knows, right now, we mostly pay the child tax credit at tax time. We live our lives for the year. We know what our income is. We know where the child lived for the majority of the year. We fill out our tax returns. In some cases, if you're middle or high income, you are sort of advancing the credit to yourself, but mostly, we're paying at tax time. You also have an option of paying the credit in advance. That's what we've been trying to do this year from July to December. And of course, you could also pay the credit after eligibility has been determined and then, make a stream of payments, which has also been proposed. A little more detail. But first, why this is necessary. So just like Jacob did such a nice job of framing that families are volatile, they're moving around. Something like 40% of children are born outside of marriage today. So there's a lot of children in these situations that Jacob's talking about that are potentially moving around. But there's also volatility on the income side. So work I did with Liz Peters a few years ago showed that roughly 40% of low income families with working age parents live in a household where their income is spiking or dropping by more than 25% over their average in 6 months of the year. So it's important to remember that if you're low income, it's not usually the pattern that you're earning the same amount of money every month. Your income is bouncing all over. And it turns out not only is it bad for children if you're low income because you're resource starved, there's a separate effect of when your income is unpredictable and your income is bouncing around that can be harmful. And one example of this is some really interesting work that Bradley Hardy did that shows when income is unpredictable, children are less likely to complete school later on. So we want to think about how do we get a steady stream of payments into households. And then there's also some recent data from these census pulse surveys that have been coming out that suggests that as soon as we started paying the child tax credit in a monthly amount, we saw food insecurity drop. And so that's another reason you might think of reasons we might want to reduce income volatility. And paying the credit monthly in advance is a way to reduce that volatility. And it also means that the credit can be most responsive to the needs at hand. So if the floor falls out from beneath a family all of a sudden, we can start getting, larger tax credits into that household. So if you want to operate how we have been for a long time, you pay the credit at tax time. That's the system where families file the return, determine the eligibility, and they reconcile the credit along with everything else on their tax form. So of course, some people can sort of pay themselves the child tax credit in advance. And that's if they have something like I know I'm going to have some investment income, but I'm not going to pay any tax on it because I'm, going to get this child tax credit that would offset that when I file my return. So as a middle or high income earner, I just sort of advance my child tax credit throughout the year, essentially by adjusting my withholding. If I'm a low income family, that option is not available because we don't allow negative withholding in this country. And so there's this inequity between who gets their child tax credit throughout the year and who gets it in one lump sum payment at the end of the year. The good thing about this system is there's no risk of overpayment. We don't send payments out the door until we know what you qualify for. And there's also no additional administrative burden set on the IRS because it's been used to doing this for a long time. The next option we have is what we did throughout the past year or half year, which is trying to pay the credit in advance. So families start to receive payments in advance of knowing whether they're eligible for them. The good news is everyone can get the credit in advance. So it sort of gets rid of that inequity that exists now. But the bad news is there's this risk of overpayment. And then we have to figure out what we're going to do with those overpayments. And we have three options. We can make people pay them all back. We can pay some of it back or choose some people that will have to pay some of it back, or we can pay none of it back. And there's examples in the tax code of doing every one of these. The most recent one of not requiring any payback would be the economic impact payments that went out the door. If you were overpaid, in general, you did not have to reconcile that on your tax return. Problem is that this increases administrative costs for the IRS. This is something they're not used to doing. But there's also higher direct costs, because if you don't have to reconcile the full amount of the advance payment you've received, then that is, increasing the cost of the child tax credit overall. And my guess is that if that gets too high, it becomes very noticeable by people who object to not requiring some type of reconciliation. The third option, which I'm not fond of, is paying the credit after tax time. Families would file their tax return. They determine what CTC they've been owed throughout the last year, and then the payment stream begins for the next year. This is essentially what they're doing in Canada, and it seems to work really well. But no one's getting the credit in advance, but everyone is getting the credit throughout the year, so that income volatility piece. But it creates a difference in the treatment of tax refunds due to your child tax credit versus everything else. So as a higher income person, if you told them it looks like you're owed $3,000 of a tax refund and we'll just pay that out to you over the course of next year, people would be on fire. And so I'm hesitant to suggest that we should move to that system here in the United States. The good news, of course, is that there's no risk of overpayment under that system. We've completely determined eligibility before a nickel goes out the door. The bad news is it's not responsive to your current conditions. So that situation where the floor falls out from you, there's no one to call for help because it's not going to come until after the year is ended. And of course, there's also increased administrative costs associated with this sort of payment. So then I think what we have to really wrap our minds around is, who is this tax credit intended for? Who are we trying to help? Who should be forefront in the IRS's mind when we're making this decision, or in policymakers' mind? So are we concerned with the median child tax recipient? That median child tax recipient is someone who does probably live in the same house throughout the year. They are eligible for, $2,000 per child. And, life for them is not particularly volatile or vulnerable. If that's who you're concerned about, then you might make different choices than if you're concerned with that low income recipient. So are you concerned with that income volatility and those households where there's, severe resource constraints during some months of the year? The other issue is we have to have an honest conversation about what we're willing to pay to reduce the risk of incorrect payments. So there's a safe harbor provision in the Ways and Means legislation right now. How many people are we willing to allow to use that safe harbor? I think the research on this is not caught up to the legislation at this point, and so we don't really know, how many folks will be at risk of incorrect payments, how many will be held harmless for these payments, and I think we ought to think about that. And then a point that I have not made is, in the course of thinking about low-income families' lives, we used to think about, there's this argument that's out there that we should pay the credit afterwards in one lump sum at tax time like we're used to. And that's because we have a little bit of research that shows sometimes people choose this option. But I just want to preempt and say that we used to have a robust safety net program, a AdvCTC, that delivered cash payments to people throughout the year. So when that earlier research was done, people had a stream of income available to them and then received this lump sum payment at tax time. the safety net is very, very small relative to what it used to be in terms of direct cash assistance. So there's not a lot of people who are receiving cash payments. And that's, I think, why there's so much pressure to think about using the tax system to deliver this monthly benefit. And as my lead into Nina's comments, which I'm very much looking forward to, I think when we answer all of these questions about reconciliation and how do we deliver the credit, we really ought to think about whether it's a provision that the IRS can administer. And we want to do that because we have this long history of watching the IRS get, thrown under the bus for not administering payments when there really is no data that exists to help them administer the payments. And so in my mind, that has to be a question that we're asking ourselves when we make these determinations. So I will stop there with these food for thought. Perhaps my other panelists want to weigh in, or if Scott has questions, I'm happy to take those too.
We do have a couple questions, but I think they're best left for after or throughout Nina's piece of the presentation. So I think we should move on to that because they're more in line with the adjudication section. So with that, let me hand it over to Nina, who's going to talk to us about a number of adjudication-related issues in the advanced child tax credit. Nina?
Great, and I will try to address some of the questions that seem to relate to this, but I want to echo what Jacob started with, which is that this is truly a significant piece of legislation. And there are many things that are accomplished, including things that many of us have been recommending for years, including replacing some of the tests with a carer definition, which has been adopted not just by Canada, but by Australia. And when UK had their credit, they were using that definition too. And then there are a lot of other components in here that are really interesting, including going to the point about getting other information. One aspect to be able to establish a rebuttable presumption that you are eligible, your presumptive eligibility, is that the agency, Treasury or the IRS, can rely on information like your receipt of benefits, so that if you are receiving food stamps or child support food stamps or TANF with respect to that child, that can be a basis for establishing presumptive eligibility. So there is some conception of the government receiving data that it currently does not get. And the final thing that I'd make just on the eligibility question is that Emily Lynn and Janet McCubbin and a few other people at Treasury did a really interesting study several years ago that showed that where we thought, where the statute said this is an improper payment because the child was not a qualifying child of this taxpayer, in many instances, it turned out that there was some kind of not biological relationship, but some kind of relationship, caring relationship between that individual, that taxpayer, and that child. And so I think to the concern about whether eliminating relationship test weakens efforts against fraudulent claims. First of all, I challenge whether it's fraudulent claims or just, people trying to deal with these definitions as applied to their family structures and their living structures. But I don't think it does. I actually think it gets us to a more accurate picture of how families live their lives. So let me go to adjudication. And I also have to say, this is just the beginning because I'm just working through this statute this proposed legislation as we all are. So again, just present day, currently, you look under Section 24 and it's determined on an annual basis, claimed on the tax return. It's subject to deficiency procedures unless you fall in under one of the exceptions for math error summary assessment authority. You don't have the right social security number for the child. Bam, it's disallowed under, summary assessment authority. And where the IRS does select a return for examination for audit based on the child tax credit, the taxpayer will usually have the right to an administrative appeal. And then when they get a notice of deficiency, they will have 90 days to petition the tax court, bring that issue before the tax court before they have to pay the proposed assessment. And that's the current, proposal. Now we have today, in the proposal for the advanced child tax credit, and I'm particularly focusing on the proposal for 2023 through 2025. The child tax credit is calculated on a monthly basis. Taxpayers may elect to receive it either as advance payments or elect to receive it as a credit against tax at the end of the year. So you do have that opt-out provision. And there are multiple ways of making that election under the statute, the proposed statute on the tax return for the prior year, through the non-filer portal, or through some other specified alternative methodology, for example, the child tax credit update portal, which we'll talk about in a second. Now, this is a very tiny slide, but I wanted you to see the language, and I'm going to sort of work through it. I'm parsing it myself. It says how presumptive eligibility is determined. It says, this is in the new 24 Cap A, which will apply for 23 through 25 if it's passed. If an individual is treated, if they've established presumptive eligibility under 7527 Cap B, then they shall be treated as the person with respect to that specified child. So we've got a new term here. As Jacob said, it's not a qualifying child, it's a specified child for purposes of this credit. And no other individual shall be treated as the taxpayer being able to claim that specified child during that period of presumptive eligibility. And then it has this little section that says, well, if you elect out, this is how I read it. It says, notwithstanding what we just said, that nobody else can get this during somebody else's period of presumptive eligibility. Then the statute comes in and says, well, we don't want you to think that if you elect out, you won't be able to establish presumptive eligibility. So say you're filing your return and you say, I mean, the way I imagine it would happen is you say, look, this child for next year is going to be my specified child, but I am electing to not receive monthly payments. And the IRS would record that in their system. So if somebody else came in and claimed that child, they wouldn't just make a decision to assume presumptive eligibility for that other person without letting you know, which leads us to adjudication. Now, that's how I'm reading that section. I don't know whether I'm right or not. All right, this is what JCT has said, because they published their explanation of these provisions very quickly over the weekend after the markup was issued at 10 o'clock on Friday night. Basically, it says, if someone has received presumptive eligibility, then the child is treated as the specified child of such taxpayer for any month in the period of presumptive eligibility, and is not treated as the specified child of any taxpayer for whom a period of presumptive eligibility has not been established. Which means if the child has moved, but the old family has established a period of presumptive eligibility several months ago, and no one else comes in while the child has moved, what happens there? Or if someone comes in and claims it, what claims the child is now a specified child for me? What happens there? You have to establish another period of presumptive eligibility. And that's where we get to well, you establish presumptive eligibility via the immediately preceding tax year's return, or via the online portal, or any other manner provided by the secretary. And they talk about this specified alternative mechanism to receive information regarding eligibility, which would be some kind of update portal for throughout the year. So they are thinking about administrability. How is this going to work? Okay, again, a lot of small stuff, but first it says where a specified child is taken into account by more than one taxpayer for any given month, The child shall be the specified child with respect to the taxpayer with the most recent reference month. Oh my God, what's a reference month? Okay, guys. So we've got some new terms here in this statute. The reference month you're looking at to see who is the child, who is the child, the specified child of with respect to the last month of the preceding taxable year if a return is filed. So if someone claims the child on last year's return, is that the most recent election? Okay, saying this is my specified child. Or the last month of the second preceding taxable year, because you can look at the year before too, if nobody's filed a return in between, or information provided by this specified alternative mechanism. Okay, so that gets us into the dispute resolution. If someone has selected on their most recent tax return, this is my specified child, that continues until, that's the reference month, that's the most recent reference month, until someone comes in and updates information. If the child doesn't show up on any return, then the most recent reference month is someone who's entered, someone enters information into this specified alternative mechanism. I love that term. I'm just going to keep saying it over and over again. All right. So when you get that information, the secretary will establish a procedure to expeditiously adjudicate the taxpayer's competing claims of presumptive eligibility with respect to the same child. Okay, so this is assuming that somebody's already established presumptive eligibility, and now you've got a competing claim. Or maybe on a tax return, you have two returns that are claiming presumptive eligibility for the same child. Now, this is really interesting that the language is expeditiously adjudicates. It's not talking about examination. And the statute also said, the proposed legislation also says that the secretary shall create procedures for adjudicating an appeal of an adverse decision. So it contemplates some kind of adjudication process and the appeal, the administrative appeal of an adverse decision. And it also says here, and this goes to Elaine's issue about not having good data, it says the secretary may enter into agreements with federal, state, local, tribal governments, or, and this is very bizarre, any other individual or entity that the secretary determines to be appropriate to receive information from them with respect to adjudicating a competing claim. Now, I have to tell you, the statute makes no changes to 6103. So I don't know how this will work, because that's the secretary can't go out willy-nilly and say to a federal agency, we've got an audit of this taxpayer named Joe Smith, and we want you to tell us whether they're receiving benefits from this, with respect to this child. That's tax return and taxpayer information. And you have to have a carve out in 6103 to have it going from the IRS to an agency. But it says enter into agreements to receive information, which could be a database that then the secretary could check against. So that leaves some questions to me what all that means. Next, we see that this adjudication process, the provision says that it is not an assessment of tax. So if the adjudication goes against household one, the original household, or the new household, whatever it is, it's something interim. We don't know what it is, but we know it's not an assessment of tax. And it also doesn't constitute an audit under 7605B. So that allows the IRS to come back in after the tax return is filed and select that return and do an audit, and it doesn't violate the no second audit rule except in really rare circumstances. So that leads to the question, well, if you are denied presumptive eligibility as a result of this adjudication process that is not an assessment and is not an audit, can you come in on your tax return and claim the child tax credit with respect to that child to trigger deficiency procedures? I have to tell you, I don't know the answer to this, but thinking about the language, looking through the language of the proposed legislation, if you keep in mind that question that I've got, you'll see that there are some provisions that go to retroactive payments and recaptures of payments as a part of this adjudication process. The first thing is that the secretary may make a one-time catch-up payment if, as a result of this adjudication process, the secretary determines that the child was a specified child of the new household, for example. He could make catch-up payments for the period in which he thinks that would be for a portion of the determination period. And the determination period is triggered by when you put in your claim through this specified alternative mechanism, or on your tax return even, and no payments were going out when you filed your claim on a tax return, and when the secretary finally makes their decision. So the secretary could, and it's permissive, make catch-up payments rather than just having them start from the date of determination going forward. Now on recap, and I think it's interesting that that's permissive, but in other areas there's a lot of mandatory requirements. With recapture, where the secretary makes payments with respect to a specified child during the adjudication payment, the secretary shall provide each taxpayer who's receiving payments with notice that such payments may be subject to recapture. So I envision that to be like, when there is this dispute that arises, the secretary has to send out a notice, and this goes to due process provisions, saying, this is now part of a dispute. We're undergoing an adjudication process, and so we're just warning you that the payments that you're getting during this time may be subject to recapture. That notice is important because it may be a prompt to the old household, the original household that maybe the child has moved out of, to one say, oh, well, I'm going to go in and elect out. I'm going to tell them that the child's no longer with me. And then we minimize any possibility of incorrect payments going out, and maybe you resolve the dispute just by triggering that awareness that I need to let people know I don't have the child anymore. And then when they make a determination, the secretary, upon making the determination, the secretary shall determine on the basis of the facts and circumstances of each such taxpayer when any of these payments should be subject to recapture, and then notify each such taxpayer. So a lot is left to the secretary issuing guidance about what facts and circumstances it's going to consider, etc. Now, one of the things that the secretary has to consider is an automatic grace period. So let's say the adjudication process drags on. You've submitted information, then there's an appeal, and in the meantime, payments are going out to the original family. And at the end of the process, it's decided that payment should be going out to the new family. Well, Congress has enacted a grace period of 3 months where there is a failure or a delay in determining presumptive eligibility. And that doesn't say a failure or delay, that the failure or delay is attributable to the taxpayer or to the IRS. It's just, we're going to give you a grace period of 3 months payments. So, you know, I had actually at one point recommended the 3 months because I thought, thinking about when you would need to get information from the taxpayer if there were an appeal, how long the secretary needed to have time to do determination. That seemed like a reasonable amount of time because it's supposed to be expeditious. So there you get that great grace period, and those wouldn't be considered recapture payments that would fall under the safe harbor, I think. So you might really minimize, you know, recapture from the taxpayer that the original household, they've already got a 3 month grace period. And then if they continue to get some more payments when they weren't supposed to, then the safe harbor provision, you know, at the end of the year when you're figuring it out, might give them protection, and then they don't have any harm to them. There is only one automatic grace period per taxpayer for every 36 months. The idea is you learned through this process that you needed to update. And so, you only need it once every 36 months. I'm not sure where they came up with 36 months. And then also you don't get a grace period where, it doesn't say the taxpayer has delayed or has committed fraud or has been in reckless disregard of, reckless or intentional disregard of rules and regulations, but it eliminates the grace period there. Then we have hardship, the hardship exception. And what this says is that notwithstanding all the adjudication and recapture rules, if there's a failure or delay in establishing a period of presumptive eligibility and it was due to domestic violence, serious illness, natural disaster, or any other hardship, which means there have to be rules or regulations that are issued about what any other hardship means, then these credits shall be allowed or made with respect to so much of the delay period up to 6 months. And there's no limitation on how often that hardship exception can be set. So let's say you aren't able, you're fleeing from a marriage from domestic hardship or any kind of relationship from domestic violence, and the last thing on your mind is going into the specified alternative mechanism and making an election for your children, and then that might give you, this hardship exception would give you a period where you might be able to get retroactive payments because of because the delay was attributable to that. This is very, so here's I know we're running up on time. Here's one of my examples. And I honestly don't know the answer to this. And this really sets up something that is, to me, very disturbing. Taxpayer A, the original household, establishes presumptive eligibility on the preceding year's tax return. Taxpayer B files somewhere during the year through the specified alternative mechanism, and that triggers the adjudication process. Taxpayer B doesn't provide sufficient information during the adjudication to prove that they are carer of the specified child. So taxpayer A continues to receive the advanced child tax credit, and the presumptive eligibility period continues. So, however, in fact, and those of us who've been involved in clinics know we see this case all the time, taxpayer B actually is the carer of the child, but taxpayer B was unrepresented. And so they couldn't navigate the IRS. They didn't understand the documentation that the IRS was requesting. And I pointed out to a 2007 research study that TAS did, which showed not only that taxpayers and EITC audits who were represented prevailed twice, were twice as likely to receive the EITC, but in that same report, we did a survey of, TAS did a survey of EITC taxpayers who were audited, and they found that 25% of the taxpayers who received the audit notice didn't understand that they were actually under audit, and 75% of the taxpayers didn't understand what the IRS was asking them to submit as documentation to prove their eligibility. So this is a real issue, that taxpayers may go through the adjudication process and not get the right answer. Well, now we know that the adjudication process isn't an audit and it's not an assessment. So can taxpayer B come in with a tax return at the end of the year claiming the child tax credit, and under audit get an opportunity to provide the documentation prior to assessment? Will the taxpayer get a notice of deficiency that will give the taxpayer the right to go to tax court? I think they would have to do it. Now, it may mean if somebody else is claiming that child in their return and they e-file first, then the taxpayer will have to file a paper return. The IRS will have to process that paper return. The IRS will have to give the taxpayer, some kind of notice of deficiency. So then the taxpayer would have 90 days to go into tax court. But what will the tax court look at? Will the fact that that provision that I talked about very early on, where if someone else has a period of presumptive eligibility, then no one else can claim that child. Does that mean that the taxpayer won't be able to prove anything in tax court unless there's some month that the child has not been under a period of presumptive eligibility. And if that is the case, then in my opinion, the taxpayer's right to appeal to an IRS decision to an independent forum has been violated, and the taxpayer is losing rights that they currently have with respect to establishing their eligibility for the child tax credit by virtue, really true statutory rights to adjudication, not to litigation, not just administrative adjudication, but to judicial litigation, where presumptive eligibility has already been claimed by someone else. And I think I'll just, I'll go.
Just on that point, can I just, because I think you're absolutely right that it has to be resolved that way, where if somebody actually steps in and says the kid lives with me and tells the IRS that, but then payments continue to the other taxpayer, they should certainly, they've done the onus was on them, but they actually took their required action. So I agree that they should definitely get that, and it needs to be read that way. Just in terms of the language you already showed, though.
Go ahead.
I'm sorry. Yeah. In terms of the language you already showed about how there's this automatic letter that would go out to both taxpayers in this sort of conflict situation, saying, if it turns out that any sort of future payments you get might be clawed back if it turns out that you weren't getting this. Do you not read that as basically cutting off the initial taxpayer's presumptive eligibility for that period?
That's interesting. I mean, you could read it that way. I didn't read that as what the statute said, but it could be argued that. But I didn't read it as the payments would stop going to the original household. They would continue, because otherwise would you need that grace period?
The grace period, as I understand it, is for not a situation where there's been a conflict, where two people have claimed the kid, but instead to be a situation, getting back to a question that was asked, like, what about someone who the kid moved into your house, but nobody reported anything, right? Under a pure presumptive eligibility, that new household wouldn't get anything until they report it. That grace period lets them get 3 months back.
Okay. I think that's really interesting. Yeah, well, it might be that it's both, but I think that you just pointed out we really need clarification on that. And I think, the other thing is, as I've thought about this, with other benefits, TANF, SNAP, there's the administrative adjudication, and then you immediately go to your judicial. You have the right to get judicial review of that administrative determination during the year. And I think that's the disconnect, that they've adopted the immediate adjudication of the other social benefits, but because we're in an annual filing system and it's not an assessment and it's not an audit, you don't get your judicial rights mid-year, you get them at the end of the year. And that's the disconnect that needs to be clarified. And I have shared that with Ways and Means, and they're aware of that concern, and they're looking at it. So, but I guess just to end with the due process issues, you will see throughout this provision that this proposed statute, that there are a lot of anti-abuse provisions, and there's an enormous amount of discretion left to the secretary to establish rules. And one of the people said, what is your concern about? One of the questions came in about, do you have any concerns about that? And I do have concerns, and I think that goes to that balance about worrying about fraud/abuse and trying to get the maximum amount of participation. And that goes to Elaine's question about who are you trying to help here? And what are you trying to do here? And I think we have to find a better balance than we have now. It goes to the point of how much are you willing to accept in terms of incorrect payments, and what slack do you want to build into the system about that? And I will say that the IRS has done a terrible job of administering the 2-year ban. There have been 2 studies by the Taxpayer Advocate Service, looking at the actual instances where the 2-year ban has been applied, and the IRS has not followed its own internal revenue manual and has harmed taxpayers, and the whole inability to get into the courts when the 2-year ban is imposed is really problematic. And I will also say that there seems to be no recognition in these provisions that people just make errors. There's a difference between fraud and intentional disregard and reckless disregard of the rules and regulations. And I made a mistake on my return. And I think that there's just not enough recognition about the complication of people's lives. And this is a complex statute, and we need to accommodate that. They tried to accommodate that somewhat definitionally by broadening the definition of who could be eligible, but still. And then the final thing is any adjudication notice needs to include information about the Taxpayer Advocate Service and also low-income taxpayer clinics, just to the point that taxpayers do better when they have representation, and that's particularly true for the low-income taxpayer.
So thank you for that, Nina. First of all, the examples were fantastic, and I think that they'll serve well as we move forward and digest this legislation. As you mentioned already, that the legislation is quite meaty, and we've only had a couple of days to absorb it. So I'm sure we'll continue to find not just issues, but maybe some answers to some of our initial questions that we thought might have not been answered. There are some questions that are still coming in, and if you're still welcome to add to those questions. We have about 10 minutes left. I also, before we end, I do want to make sure I do thank some folks, and I failed to do at the beginning. The folks at Treasury and the White House and the Hill Tax Committee staffers have just poured their everything they have into this proposal over the last several months. I know many of them, and they haven't been sleeping. Their spouses are wondering where they are. For all of the potential issues we find today and pick on this or that, the overall effort is tremendous. I think we could all agree, and that everybody's kind of working for the same solution. So I want to just hats off to those folks who have been burning the midnight oil extensively over the past several months. And no doubt they'll be continuing to do so over the next few months until this legislation gets to where it needs to go. So I just want to make sure we acknowledge that before we continue to dive into some of the concerns or questions people have. One specific question that was just asked, and then we will go to some more of the general questions, was for 2021. The advanced child tax credit payments are not subject to offset for past due taxes. But this exemption does not seem to carry over to the portion of the child tax credit to be claimed on the 2021 return. And the question that's asked is, does this proposed legislation address this quote unquote inconsistency for 2021 or for a going forward basis? So let me open that up to the panel here if they want to. Nina?
Yeah, I think that as I read it, they carry over the same approach. That they protect from offset for taxes and also for the Treasury offset program, but only for the advanced payments. And it doesn't seem to provide the same protection for the child tax credit. But if somebody else, again, like you said, this is a very long statute, legislation. So I may have read it wrong if somebody sees it differently.
Before I go on, does anybody else want to comment on that, or is okay? Next question, and there's a lot of kind of that goes in that seems to be asking something around these points. They're not all the same question, but they seem to be going to the same instinct, and that is there seems to be some folks who are asking questions here who are concerned about massive overpayments, and that this project or this proposal costing a lot more than the initial ticket. The amount it's been slated for. And I think we've been talking a lot, and one of the themes of this panel has been the tension, as I think I mentioned early on, and I know Nina just referenced again, and apologies for me disappearing a couple times. I'm having some internet connectivity issues, it seems, is this tension between, on the one hand, making sure that this very important program reaches all the people it's intended to reach, and in particular the folks at the bottom of the income ladder, to help them get out of that situation. And on the other hand, making sure that it's not so fast and loose that it gets to all those people and then some, and that everybody's getting the double dip, or that there's a significant overpayment. And obviously, the IRS is very concerned about overpayments, and there needed to be particular language in the statute or the proposed legislation that gave the IRS enough comfort that they would feel that they were not shirking their responsibilities by making payments when there was potentially uncertainty as to who the recipient would be, the eligible recipient would be. So with that, I just want to open it up to the panel. Anything you see in here that we didn't already discuss that might be a possibility for tightening it a little bit, as far as making sure payments aren't going out to the wrong folks, and at the same time going to the right people? And I guess, again, we might have exhausted this point already, but I think it's going to the heart of some of the questions we're receiving.
So I think what I'd like to point out is what this question gets at is the heart of the IRS used to be an agency that collected taxes, and it's not set up as a benefits administrator in any large scale. And we're asking it to become a benefits administrator. And so these are questions that benefits agencies have been dealing with and have a long history of. And so, there's, some reasonable people might suggest you look at what's being done in transfer programs. What happens in Social Security when the payment goes to the wrong person? Who's obligated to repay? So I think there's places we can look to figure out the answers, but it also points out to something that, Nina has talked about for many, many years, which is the IRS, if it's going to administer these programs, needs to have a piece of it that's dedicated to benefits administration, to answer these types of questions and be able to explain what's going on to everyone.
Yeah, to that point, I've proposed the Family and Worker Benefit Unit, FABU, as something that needs to be established. And I've actually recommended the IRS is getting $9 billion to administer this program. There should be a legislative directive that says, and you use some of that $9 billion to establish a Family and Worker Benefit Unit dedicated just to the administration of social benefits that are administered for the benefit of the family or workers, like the Earned Income Credit, through the code, and that you hire employees that have that social work background, that have that focus. You establish different performance measures for that unit. You define compliance not from a law enforcement point of view, but from a social benefit and delivery program point of view, which has a compliance program component, but it's not the same thing as you're approaching with offshore, avoidance or something, or even evasion. And I think that, to the point of, the IRS, since the 1990s at least, has been a social benefit administrator. It's just not acknowledged it. And, to some extent that was mission creep, but now it's tipped. And with the Affordable Care Act, it truly tipped. And so it needs to wake up, it needs to accept that, and it needs to organize itself around it. And Congress needs to give it a little nudge. Now, that's my personal opinion.
And Nina, I guess it goes without saying that one way to do this is through specific legislation that defines everything you just discussed, and others to give somewhat broad Treasury some regulatory authority to implement this the best way they see fit, and it could be you don't want to over legislate it at the same time, I suspect.
I don't think that saying to the IRS that not, if you look at the Treasury appropriation, they've told it with the money that they appropriated to Treasury, you will use part of this for outreach and education and I found it very interesting that they did not tell the IRS to use some of it for outreach and education. Does that mean that they don't trust the IRS to do the outreach? They want Treasury to do that's very unusual. I really think that Congress should give some direction. And if you look at the appropriation bills, they're always giving the IRS directives on how to spend their money. So whether it comes in through the actual appropriation grants saying create this unit, but to me, you need to recognize that you have two lines of business two missions. One is to collect revenue and one is to disperse social benefits.
Okay, so thank you all for that. It's 2:32. I think we have like 1 minute left. I just wanted to first, again, thank these my three panelists here who just did such a wonderful job in assisting me in getting all these slides together on such short notice, with basically working over the weekend to ensure we got here. I hope you all enjoyed the program, and I do want to mention that I'm almost certain we'll have a follow-up to this program in due course once we get our arms around this legislation a little more, and there's further progression of the legislation through the House and the Senate. So with that, I want to hand it back to our wonderful host or moderator. What are we going to call them? Our person I'm supposed to hand the microphone back to. So with that, thanks everybody for joining. And our contact information is up here in case any of you want to reach out to any of us to ask us follow-up questions.